Good evening for those of you who might be joining us from other parts around the world, different countries. I know we've got some people from Australia joining us today and some people from, some attendees I should say, from the UK as well. So welcome everyone. We're starting the broadcast now just a moment early. We want to make sure that everyone can hear us okay and that we're coming through all right. And we're going to give some minute or so to allow more of our attendees to join us. Today's discussion, of course, is going to be the strategy discussion on Iron Condors, Neutral Trading, Part 1. We changed the title to Part 1 because we realized we have a lot of information, and we're actually going to go ahead and launch Part 2 on April 9th, Friday, April 9th at about 12 noon Eastern again. And we might even have a follow-up to Part 2 where we're going to showcase all the PowerOptions tools for using the Iron Condor position, including the search tool, the patented search tool there, and the portfolio tools. But today we're going to focus mainly on the strategy that was discussed in the Iron Condor book. We're going to talk a little bit about that text as well. It was written by Mike Phillips, the head analyst of PowerOptions Applied. He's going to be the one who's going to be guiding us through this presentation today. The book and the presentation are going to reflect the concepts and the strategies that he uses to trade the advisory newsletter services at PowerOptions Applied with the Chromium trade folio and the Optium trade folio. Okay, got a couple questions coming in, and I'll take on those right now. Ben wants to know, Mike, is this being recorded? Yes, Ben, this is being recorded, and I even have a backup recorder in place to record this presentation, so we're going to have this archived. I believe this is Emmett. I don't get to see the full name, so I apologize. This is not Emmett. Emmett wants to know, is it okay to ask questions? Emmett, yes. Myself and Greg Zarenner are going to be answering the questions as they come through, but it'd be really great if you hold your questions at the end. We're going to try to leave some time there at the end to handle the questions so that everyone can take advantage of that that's in attendance today. So please, Emmett, feel free to ask questions. Greg and I will try to get to them, but if we see the question will apply to the whole group, then we're just going to wait and address that at the end. Barry, quick question, wanted to know what is the difference between PowerOptions and PowerOptions Applied? Well, PowerOptions, we're going to discuss this a little bit later on, Barry, but for now I'll just give the teaser. PowerOptions is a suite of patented tools for self-directed options investors. We support over 23 different strategies, including the Iron Condor. You can do your own searches, analysis, research, put in the positions that you want to see. PowerOptions Applied is more of a time saver. For those that don't have the time to do their own research and analysis, at PowerOptions Applied, they do the work for you. And Mike Phillips, I'm Mike Chupko, of course, Mike Phillips is going to guide us through that. All right, well, I've got some other questions coming in, just quick ones. We're going to address those once we get started. Gerald, I'll just repeat it. Yes, this is being recorded, so you guys will be available to watch it later. Roland asked the same question. The recordings will be made available. We're not going to make a CD out of this, Roland, but you're going to be able to access it for free at any time on PowerOptions or PowerOptions Applied in the archive. I tell you what, ladies and gentlemen, according to my clock, I've been talking for about 3 minutes now. We've got a lot of our attendees and still people rolling in. But why don't we go ahead and get started? I'll just welcome everyone again. It's good to see you here to today's discussion, PowerOptions strategy discussion for the Iron Condor and neutral trading. Again, the focus of this presentation is going to be based on the information in our most recent publication, Iron Condors, Neutral Strategy for Common Profit, written by Ernie Zarenner, the president of PowerOptions, and Mike Phillips, who is going to be guiding us through the presentation today. He's the head analyst over at PowerOptions Applied. Barry, to give you a little bit more in depth, this we kind of reviewed here, but we'll review it for everyone. Now, PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. Ernie Zarenner created the site over 12 years ago with his partner, essentially to trade his own personal accounts. These patented tools will allow you to search the universe of options in over 23 different strategies in less than a second. You'll have quick links then to quickly compare the risk versus reward on your positions or compare it to other strategies. We also have a powerful suite of portfolio tools which will help you paper trade, track, and manage your positions. In addition to that, there's volumes of educational articles, educational texts for the different strategies, archived webinars on different strategy discussions like we're doing today. And as I mentioned, we've been in business for over 12 years. We have many more years combined trading experience with all the staff online here, with Ernie, myself, Greg, Mike Phillips, the programmers as well. We all trade and here at PowerOptions, and we all use PowerOptions to do our trading, to do our research and analysis. As I mentioned, my name is Mike Chupka. I am the Director of Education here at PowerOptions. I handle a lot of the coaching session and the education on the website. I've co-authored 2 option books with Ernie, one on naked puts and one on protective option strategies focusing on married puts and collar spreads. I am, of course, versed in all 23 different strategies on the PowerOptions site, but there are certain strategies I don't trade myself. I won't trade naked calls, for example, iron butterflies, short straddles, or short strangles, because they just don't match my personal risk-reward tolerance. But if you are a self-directed investor, you're looking for a powerful suite of options tools, and you take a trial or you're a subscriber to PowerOptions, I can help you with all those tools there. Now it's time for me to introduce Mr. Phillips, Mike Phillips, the head analyst over at PowerOptions Applied. Say hello, Mike, and why don't you tell everyone a little bit about yourself and about the book you recently authored.
Welcome, welcome. Well, actually, I'd have to say I'm the co-author with Ernie, but yeah, I've been working at PowerOptions for 5 years. Actually, before that, I was an engineer and designed computer chips for a number of years. Worked at a couple successful startup companies and decided to get into the financial world.
Mm-hmm. Now, you were trading these types of strategies, and you were trading before you came on board with PowerOptions. Isn't that correct?
That's correct, yes. Mostly covered calls. The Iron Condor is more recent since coming to work here.
All right. Now, you run the advisory newsletter service at PowerOptions Applied. Why don't you tell us a little bit about that?
Well, PowerOptions Applied is more geared for investors that really don't want to take the time or have the interest to trade options for themselves. And so we do that for them. We do all the analysis and search, and then we can also we have relationships with some brokers where we can do auto trades, so we can actually trade the positions for you if you want.
Mm-hmm. All right. And this are the 2 different services that we offer. We're going to go in depth later on at the end of the presentation into the different trade folios that are available in PowerOptions Applied. You can always check those out. But why don't we go ahead now, Mike, and continue on. And I believe what we want to do next is launch a poll here. We want to get to know you guys a little bit better, those of you that are in attendance today. And the first poll that we'd like to start off with is, what is your experience with options? Are you brand new to the options trading? Do you do some of the basic strategies, level 1 trading, maybe just covered calls and long calls? Are you doing intermediate positions, maybe collar spreads, married puts, or different kind of techniques, protective strategies? Or are you doing more advanced positions, vertical spreads and the Iron Condors already that we're going to be discussing today? We're getting a lot of votes come in quickly. That's great, guys. Thank you very much. Looks like we have a clear winner here, Mike, as we should have expected since this is the Iron Condor presentation.
See a lot of advanced traders tuning in today.
Mm-hmm.
Not very many newbies.
Very few new people. That's fantastic. All right. Okay, let's go ahead, and we've got about 3/4 of our attendees voted. We don't want to leave the poll open for too long. Why don't we go ahead and close that poll, and we can share the results with everyone. And it looks like what we have is 3% are brand new to trading. That's great. You are going to get a lot of useful and powerful information out of this presentation. 23% of you right now are looking at the basic strategies, such as covered calls and long calls, for example. And we've got 21% doing some of the collars and the married puts, the intermediate positions, and 53%, over half of our attendees today, are really getting into the vertical spreads, the Iron Condors. We've got some advanced, a lot of advanced customers there. That's fantastic. Advanced attendees, I should say. All right, let's go ahead and hide those results, and let's continue on with our presentation.
As I mentioned earlier, PowerOptions Applied is a newsletter, and it's more geared for people that are not self-directed. They kind of want to be coached as to how to trade. We currently support 4 different strategies in PowerOptions Applied. We support Iron Condor, covered calls, collars. A collar is a covered call that has some protection, and then we also support the double diagonal. As I mentioned, we have auto trade relationships with some select brokers, and then we also have BrokerLink, which is, as far as I know, no other newsletter has this, which is we post the trades on our website, and if you can review the trade, and if you like it, then you can trade it with some, we have some select brokers again with one click.
Mm-hmm.
Okay, we're going to do another poll.
Okay, so we're going to launch a secondary poll here, folks. We want to know, what is your experience with PowerOptions Applied, the advisory newsletter service? Is this the first time that you've heard reference to the service, PowerOptions Applied? Have you maybe checked out the website, PowerOptionsApplied.com, and read some of the free information? Have you previously tried a free trial, 1-month free trial to PowerOptions Applied, one of the different trade folios there that Mike just mentioned, whether it's titanium for the covered calls, palladium for the collars, for example, quantium for the double diagonal, or chromium and optium for the Iron Condor positions? Were you a previous subscriber to PowerOptions Applied? Maybe you were in the past. Or are you a current subscriber to PowerOptions Applied? Just let us know what your experience is with the advisory newsletter service there.
Looks like we have a lot of first-timers.
Okay, that's good. That's great.
We have a few current subscribers. Awesome.
All right, let's see. What do we got here? Okay, we've got most of our votes in. It's been open for a minute, so why don't we go ahead and close that poll, Mike?
All right.
And let's just share the results with everyone.
All right.
So, fair portion, 49%. This is the first time that you've heard about the advisory newsletter service. 35% of you have checked out PowerOptions Applied before, read some of the information on the site. 6% of you are current subscribers. 7% have reviewed this before, and 4% were previous clients. Okay, so we've got some background here, but the 49%, this is the first time, we're not going to, that's perfectly fine, because we're just going to discuss the strategy here in a couple minutes. We're going to get really into it, and we're not going to do a big sales pitch here. Most of this is going to be just meat and potatoes on the Iron Condor strategy based on the recent text that was written by Mike Phillips here and Ernie Zerender.
And here's the picture of the book. And you see the nice testimonial that one of our customers sent in. We published the book like on Friday, and we had this testimonial in by Monday.
Monday, yeah.
So, and we won't be going over Figure 4.2. So, if you want to see that, you'll have to buy the book. Hold up there. The Iron Condor strategy. It's a leverage strategy, and so it can be very dangerous. That can happen when you have a leverage position. So that's why we're going to kind of go through how to avoid some of the pitfalls that occur with Iron Condor trading. For the Iron Condor, you don't have to buy any stock. It's all options. The risk is limited, but you can lose all of the money that you invest, but you won't lose. If you trade it responsibly, you won't lose more than what you initially were at risk. The Iron Condor is eligible for special margin with brokers, with some brokers. Now, I don't think all of them support it, and we'll go into that in more detail a little later. But it's a really nice feature of the Iron Condor where you can actually kind of double your return.
Mm-hmm.
The Iron Condor is a neutral strategy, and so the market. A lot of times you watch the market, it just kind of hangs around in the same area. Maybe it bumps up a little, it goes down a little, and maybe it's on a trend and it trends up slightly or trends down. And then occasionally, once or twice a year, maybe it makes a great big move. And so the Iron Condor is in those periods where the market is neutral, works very well. It's in the periods where the market makes a sudden movement up or down, a very large movement up or down, that it doesn't work so well.
Mm-hmm.
The Iron Condor is a nice complement to other strategies. We tell customers, or we recommend customers, don't put a huge amount of money into Iron Condors, and that diversify among your strategies and maybe only put 10 or 20% into the condors, because there's a very small probability of, even the way we traded, of having a very large loss. And so that's why we recommend not putting everything into this strategy. The tax advantages, you can see there's a link on the PowerOptions Applied site that you can go to and read up on how the tax advantages. We're just going to kind of mention them today. We're not really going to go into the tax advantages too much, but you can read up on that. Okay, we're going to do another poll.
All right, so this next poll, for those of you that are currently trading Iron Condors, what we'd like to know is what percentage of your portfolio do you use for the Iron Condors? Are you trading with 10% of your portfolio into the Iron Condor positions? Are you using 10 to 20%, I'm sorry, of your available cash now to trade the Iron Condors? Are you using maybe 20 to 30%, 30 to 40% of your funds allocated to Iron Condors, or are you using greater than 50% in your trading account?
Looks like we have a lot of people that agree with us.
That's good. That's good.
All right, I'm going to go ahead and close this. I think we have a clear winner.
All right, so it looks like that we have 52%, as you mentioned, Mike, are using less than 10%. And that's good. You know, as you mentioned, there's reasons why you don't want to risk too much. Now, 23%, a little bit more aggressive, but they're still hopefully managing it well, are using 10 to 20% of their portfolio. And then we have a three-way tie. 8% of the attendees that voted are using 20 to 30%, 30 to 40%, or greater than 50%.
All right, we have some gamblers out there. That's okay. Okay, the Iron Condor is basically a combination of two very popular strategies, the bull put credit spread and the bear call credit spread. And we take these two strategies, combine them together, and we get the Iron Condor. Now, credit spread is entered by selling one option and buying another option. You sell option at a higher premium than the lower option, and when you do that, you receive a net credit. And the amount of margin required is, you know, the difference between the strike prices for the options.
Mm-hmm. Right. So if I'm looking at let's say an ETF that's trading at 100, and I did, of course, a bull put credit spread, which was the first part of the last slide that we showed in the first position. If I sold, let's say, a 90 strike put and bought an 85 strike put to enter into that spread, my maximum risk, the margin on that side would be 5 points.
Right. Right. Mm-hmm. And then the object is for at expiration for all of the options to expire worthless, and then we keep that the initial net credit that we brought in. Now the bull put, so, you know, is that a bullish strategy or a bearish strategy? Give me a little hit. You know, the name says bull put, so it is a bullish strategy, and so the bull put performs best when the market is, you know, neutral or increasing in price. And then an example, we'll show an example of a bull put. Grab my highlighter here. We would sell a short put option, in this case at $3.95, and then we would buy a long put option at $3.85.
Now, typically when we do this position, this would be on a stock that was maybe, let's say, trading at 410, 415. We'd be selling the put out of the money in this case. We don't want to sell a put that's in the money because we want to look for a higher probability, of course, that the position is going to remain out of the money and both puts would expire worthless at expiration.
That's right. This is a further example of that position we just showed you. for example, this is an actual trade that we entered. It was on July the 24th of 09. The OEX index was at 452 on that day, and we sold to open the August 395 put option for 55 cents, and then we bought to open a August 385 put option for 36 cents. The net credit that we got was 19 cents, and the maximum risk is the spread between the two options was $10, and so the maximum risk is that is the net credit subtracted from that difference, and so that would be $9.81, and the potential return, which we'll talk about later how to calculate that, is 1.9%. Then we have the bear call. You know, is that bearish or bullish? Well, it's bearish because it has bear call in the name. This is an example of a profit loss for a bear call credit spread, and the bear call credit spread performs best when the market is neutral or drops in price. And this is an example that we entered into where we would sell a call option at a strike price of 500 and we buy a long option at 510. And this trade is also entered on the same day, on July 24th, 09, when the OX is 452. In this case, we would sell to open an August 500 call option for 26 cents. We bought to open an August 510 call option for 15 cents. The net credit, the difference between those was 11 cents. In this case, the maximum risk is $9.89, so you take 10 and subtract 11 cents. $9.89 potential return was 1.1%. You put those two together, and you have the Iron Condor. We have the bull put on this side, and then we have the bear call on this side. And so we have this net neutral strategy. This was the original stock price, somewhere near the middle. For Iron Condor margin, there's two cases. We can do non-special margin or special margin, and we'll talk a little bit more about that. The conditions for special margin, now not all brokers support it, but some do. And one of the requirements is that all of the options have to be in the same month of expiration. You can't have an August and September option. They all have to be the same. Additionally, the difference between the spreads for the bear call and the bull put have to be the same. And in the example we just showed you, the spreads were the same. They were both a 10 spread. If one was a 10 spread and the other was a 20, then it wouldn't qualify for a special margin. In this slide, we're going to show you how to calculate the margin for a non-special case. And in that case, we take the difference between the short put strikes, and then we add that to the difference between the long, the
call strikes, right?
The call strikes, and then we subtract the credits that we got for the bull put and the bear call. And we multiply that times the number of contracts and times the number 100 shares per contract. And this is an example. This is actually the example we just mentioned, where we had the bull put spread at 385, 395, and the bear call at 500, 510. There's our net credits, and then this, the 1970, is the amount of margin required for the non-special case. Special margin, the difference between that is we're going to take the maximum between the bull put, the maximum spread between the bull put and the bear call, and only use one side or the other, not both. And then we will subtract the credits just like we did in the previous equation, and then multiply by the number of contracts and then 100 shares per contract. Taking the previous example of the bull put, where we had the 385, 395, and 510, 500, 510 for the bear call, and then the same net credits. Our margin is $9,700. $9,700, which is about half of what it was before. And so this is really cool feature, but it can also be very dangerous because now if there's a real potential that you can lose everything you've invested with the This should have been special margin example. Sorry, this slide is wrong. This should have been special margin example. So here's the two. We're going to compare the two cases. Special margin 9,700, non-special 9,700, non-special 19,700. So it's about half for special margin. To calculate the put return for an Iron Condor, what we do is we take that initial net credit that we receive for the bull put and the bear call, and we multiply that times 100 shares per contract times another number of contracts, and then we divide that by the margin requirement that we had on the previous slide. Okay, we're going to do another poll. Let's see, potential return.
Okay, so this, for those of you trading Iron Condors, we want to know what is a typical potential return. Are you expecting to make less than 5%? Usually over, as Mike mentioned, you typically want to, when you're selling a credit spread or doing an Iron Condor, you want to stay, usually under 60 days out in time. So just with that time frame, are you usually expecting to make less than 5% on your positions? Are you looking to make between 5 and 10%? Are you looking to make 10 or 20%, really leverage your positions? Looking to make 20 to 50%, meaning you're pretty close to at the money at this time, and you probably have a lower probability of success. And if you're going greater than 50%, well, that's a pretty high return. You might be entering, I should say, into some pretty aggressive strategies. And also, for those of you who aren't trading the Iron Condors right now, the other ones who are doing the basic or the intermediate, the Mary puts or collars, let us know, too, what your potential return is that you're looking for there.
All right, I'm going to close this. We have a clear winner. Share that.
Okay. All right. So it looks like 58% are looking to earn between 5 and 10% on the Iron Condor positions or on your standard positions. 21% going a little bit more conservative, looking to make less than 5%. 15% are looking to make 10 to 20% on their Iron Condor positions. And we do have a small amount who are looking to make greater than 50%. Is that 1%?
I think that's 1%.
Yeah, 1% of our attendees are looking to make greater than 50%. So they're either taking on positions that are really close to the underlying stock price, just going at the money, or maybe they're trading really volatile positions that have inflated premiums, such as maybe biotech stocks or lower price stocks, for example. Or some investors might be taking aggressive positions on, let's say, single strike stocks or single strike ETFs where they only have $1 or $2 at risk, but might be trying to make 50 cents or so.
Okay, we'll have that.
All right, Mike, we've got a couple of questions here that I just wanted to bring up. Greg and I have been answering some of them, but one question I think that came in that might be important, I know you might be getting to this later on, but Mary wanted to know, can this be traded in a Roth IRA with non-special margin?
Yes, with certain brokers. Not every broker allows that, but you can trade these in IRA accounts, and you can trade them with special margin or non-special margin, either way in an IRA account. Okay, on potential return for the previous example, for non-special margin, we would have a return of 1.5%. But if we have a trade that in this particular case had a special margin, use special margin, we would have a return of 3.1%, which is double. So by using special margin, we've doubled the potential return. This chart shows the probability of success versus potential return. This is a chart from the book. And what we want to show on this chart is how successful you would be versus kind of the potential return that you're going for. And so let's say you, it was about 1% said they were going up in the 50% range.
That's right.
And their probability of being successful is like around 45%. So, about half of the positions, that they would enter would be unsuccessful. You know, if they didn't do some management.
Right, they'd be forced to management.
Right. Now these positions were over several months. I took the OEX index and I just took an initial position with a certain return and then would see at expiration which ones were successful and which were not successful. And then we have this range right in here where the trades are all around 5% or less, but you can see we have a probability of success of greater than 80%, and some even up in the 90%. So this is, you know, if you go for positions that have a little lower return, you have a very much higher probability of success. And this area is this lower percent return, higher probability region is the area that we focus in for our newsletters. We don't we don't get into this area where you have higher returns, but then you have a lower probability of success.
Yeah, and the key is with these kind of leverage strategies, and we saw that when you were showing the position itself, you know, we were taking on a position that had about a 10-point risk, and we were making you know, a total net credit of about 3% on that with a special margin. Well, with that kind of risk-reward setup, if you do nothing and you just leave the positions alone, you're going to have to be right 95 to 97% of the time just to make money. One trade can wipe out 5 or 6 previously successful trades or more, depending on your risk-reward setup. And that's one of the keys with PowerOptions applied, because you have systems in place to manage the positions before you get into too much trouble, don't you?
That's right. That's right. And then when trading the Iron Condor, you have several options for trading the strategy. You can select stocks, you can select ETFs, or you can select indexes. And right now we're going to do another poll. And so on this poll, what we want to know is the investors trading Iron Condors, do they do stocks, ETFs, or indexes? Well, we have a winner, but it's
not what you expected?
Fairly evenly distributed. Yeah, I'm very surprised actually. I'm gonna close this.
All right.
Share it with our participants.
All right. So we got 42 trading Iron Condors on stocks, and that's interesting because the stocks, you know, have the higher tendency to have a sudden spike in the pre or after market hours that can get you into trouble if there's any kind of early earnings warning announcement or boardroom scandal or incorrect reporting. You know, you could have a sudden drop one way or the other that could really affect it. We've got 50% who are trading ETFs. I'm assuming a lot of people are doing SPY and maybe QQQ, for example, the more standard ETFs. And then we've got 58% doing the index options, or the indexes.
Well, that's kind of agrees with us. That's where we kind of focus more on indexes. But I'm really surprised at how many are in stocks. So we'll talk some more about that right now. Yeah, as Mike's just mentioned, the problem with stocks is that you can overnight have a company can have good news or bad news, and this is a particular stock, HGSI, which, as you can see, it jumped from around $3 one day to up over 12 on the very next day. Now, if we had entered an Iron Condor position for HGSI prior to this big price change, and let's say we did one that had special margin, and this big price change would have pretty much wiped out all of our capital except for our initial net credit. And so that's one kind of the drawback with stocks. There's some other issues with stocks as well, is that and we'll talk about indexes later, but there are some advantages in trading Iron Condors for indexes, but with stocks there are no tax advantages like for the indexes. With stocks, it's more difficult to diversify, whereas ETFs and indexes already have some diversity.
Mm-hmm.
Another issue is that stocks can have low liquidity, which can result, for the Iron Condors that the arena that we invest in, we typically try to get out of the money, and when you do that with a low liquid stock, there may be very low open interest and also have very wide bid-ask spreads. So
Mm-hmm.
it's can make it more difficult to trade the positions. Another thing is that price of stocks, most of the time they try to keep, unless it's Berkshire Hathaway, they try to keep the price under $100. And what we found is that when you trade Iron Condors at indexes, stocks, ETFs that are less than $100, you have more brokerage fees because you have to ultimately enter more contracts to get into the position. The other selection choice was ETFs, which we had half the people in that. And ETFs are certainly, with that, you're diversified. You don't have the problem with diversification like stocks, but compared to the indexes, you're not eligible for the tax advantages. The tax law, as far as we know, you can check with your financial, accountant, advisor, but as far as we know, ETFs don't qualify for tax advantages because the tax law says to qualify it has to be a broad-based index, and an ETF is not a broad-based index. Again, with ETFs, some of the ETFs, not all of them, but some of them also have less liquidity like a stock, and so you can have very wide bid-ask spreads. And again, just as in the case of stock, most ETFs, they try to keep the price at less than $100, and so again, you have higher brokerage fees.
Mm-hmm.
And Iron Condors are really nice because most of the prices of the indexes are very high, like there'll be 1,000, or in the case of S&P over 1,000, or in NASDAQ, they're thousands in the thousands range. And what we found is that when you trade with the indexes like that, you have fewer brokerage or fewer contracts, which means you have lower brokerage fees. And again, I have the website where you can go read up on the tax advantages for the trading iron. Actually, it's trading spreads. It's not just Iron Condors, but if you trade spreads with broad-based indexes, there are some tax advantages. And then with indexes also, there's very high liquidity. Lots of people trade these, so you don't have as much a problem with the bid-ask spread and low open interest as you do with the stocks and ETFs. Now, with the way we trade Iron Condors, it's generally smooth sailing. Usually we enter the positions and pretty much that's it for the month. Sometimes we roll positions to make more income. We'll talk about that in the next webinar. But what we want to do is stay away from the edges of the Iron Condor. In this case, a waterfall. I'm supposed to throw in a little story, but when I was a kid, when I was about 4 or 5, we went to this lake, and it was kind of on a hill, and it's my brother and I, and we decided we'd have a race down the hill to see who would win. Well, we got to the bottom of the hill, and I couldn't stop, and I ended up in the lake. My brother didn't end up in the lake. So the moral is for the Iron Condors, we want to stay away from the edges. So, and when we talk about edges in this case, we're talking about this area of the Iron Condor, where we're close to the short option strikes. And that's what we'll talk about more in the Iron Condor webinar, next one that we'll have April 9th, which will be a follow-up. And the one on April 9th, we will kind of review what we went over today a little bit. Briefly, we won't cover everything. And then there'll be some new material. We'll talk about how to manage stop losses. We'll talk about contingent orders. Contingent orders are orders that you can set on an Iron Condor position that will automatically exit you if the underlying crosses a certain point, because most people aren't trading all the time. They're working. They're in their business, and they don't have time to watch trades all day. And so the contingent orders are nice because they can automatically exit position. And we'll talk about rolling and how we have one of our trade folios, chromium, and rolls. And so what we do is we enter the positions, and then a couple weeks after we enter the positions, we'll roll. And what that does is it allows us to realize more potential income. We'll talk about some bid-ask spread issues. I touched on it a little earlier, but we'll get into that in more detail off next time. And then we'll also talk about We'll also talk about some Iron Condor variations, the double diagonal and the iron butterfly. Do you have a comment, Mike?
Oh, well, we had a question from David who said that actually I was going to, since you're getting near the end here, I was going to bring up some of the questions. And David did bring up a question that says he's had problems doing the cash indexes there. I'm sorry, or the cash-only indexes getting filled at reasonable prices through CBOE. That he hasn't been able, I guess, to get the between the bid-ask price. And you've normally had good success doing that, haven't you?
I've had a lot of success with that, and part of that is because we do go and trade the indexes, so there's a lot of liquidity, and that's part of the key to this success with this strategy, is to trade indexes and ETFs that have a lot of liquidity so that you can get it filled. Now, there's occasions when I don't, or we're not able to get the trade midway between the bid-ask, and so we'll drop it down, and maybe we don't get quite midway. But that is one way that we kind of supercharge our returns, is by getting trades at the midway between the bid and ask spread.
Okay, and you can, of course, use the Iron Condor technique on futures and commodities such as gold and silver as well, can't you? You don't do that yourself in PowerOptions. It can be applied.
I'm not an expert in the futures and commodities, so I can't really answer that question. I know that there's a strategy called an Iron Condor, but it's not exactly the same as what we're doing here. It's a little different. So I really couldn't even comment on that. Any other questions?
Yeah, I have a direct one right from the book. Emmett wanted to know that he's currently reading the Iron Condor book. Thank you, Emmett. And on page 119, it shows the formula for the 1% stop loss calculation. Now, this is something that you reference in the book, where using the stop losses on these positions, you look to maybe close one leg or the other if the stock reaches within 1 or 1.5% of the short put strike price, or 1 or 1.5% of the short call strike price. But what Emmett mentioned is that he wasn't getting the math to work. Where does the 1 shown in the formula come from? He asked this earlier on, but he's going to wait for the answer. You can address that if you want, or Emmett, we'll just take your question. We'll have Mike reply to you directly via email.
Yeah, it's a little tough since everyone else doesn't see page 119. But basically, what we're doing is we're adding a 1% margin for the put short strike, and then we're subtracting a 1% margin from the short call strike, and that is an example 1%. That we'll talk about this next time, but we vary that margin based on market volatility and based on the underlying index. For example, on an OEX, we might use 1 or 1.5%, but if we do Russell or NASDAQ, we might do 1.5 or 2%. Or if the market's very volatile, we'll even go up, to 2.5%. And that kind of goes back to the slide that I showed before with the waterfall, is that we want to stay away from the edges, especially with these indexes, because once you get close to the edge, it can be very difficult to get out without losing a lot of money. So. Any other questions? And if I didn't answer Emmett's question, we can converse with him via email or a phone call. Be happy to answer email or phone call.
Jason, I've got a question that I can answer for Jason. Jason, I'll probably answer this more to you in an email. Jason follows us with the radioactive trading methodology, and he wanted to know how can we apply this to non-ETFs. We have a long stock or a married put position. One of Kurt's methods, income method number 8, actually approaches that. Now I'm mixing strategies there, but to answer Jason's question, income method number 8 can be used on a married put position that you're trading radioactively there. And it's based on this Condor technique, but it's a little bit different because you already own the stock and you're protected. Guillermo wants to know if you traded Iron Condors with OEX for the weeklies rather than instead of the monthly time frame.
I have done some paper trading on that, and there's not as much liquidity. So once again, you have a problem with, trying to get a nice execution. And the other thing is that, once you get closer to expiration, you really have to manage and watch the position very closely. And I'm not one that I don't want to have to watch the position every minute, every day. And that's what you have to do if you're going to trade the weeklies. You have to really watch them very closely because you are already very close to that waterfall. All right, you're not in smooth water. You're already kind of jumping into the choppy water. And so, but you can do that, and I have done it. And I know we have some customers that do that, and they have had some success with that. So, but yes, you can do that.
Okay. Let's see. I had another question here that's more of a technical question. It's from Walter. Okay. Mike, I'm assuming he's asking you, not me. But
okay.
Do you project IV for future weeks as part of choosing your strikes for the Iron Condor? When you're selecting how far out of the money you're going, do you project an implied volatility for the future?
No, we kind of look at just the current volatility. We don't really project too much. Yeah, that would be an interesting study to see a projection of volatility versus success. But it's a little harder to do. But yeah, that would be an interesting study.
Okay, let's see here. We did have some other questions that we might get into in the next presentation regarding the range out of the money, for example, or the probability. And what do you kind of look for when you're opening your Iron Condors? And this is, of course, discussed in the book, but you want to have a decent range. You want to have a good combination, as we discussed before, based on having that range that you were looking at, that 90 or 85% success rate, while still at the same time just having reasonable profitability on the position. You can get a higher potential profit with a lower probability, but what do you basically look for on that when you're sticking with the kind of under 5%? Isn't that right?
Well, typically we're looking for trades that are like less than 8%, and also have probabilities of success, in the 80% or greater range.
Okay.
That's really the area that we like to focus on. Again, those positions where you're going for higher risks, again, you're jumping into the choppy water immediately. And so they require more work, and you have to watch them very closely.
Okay, let's see here. Now, of course, we did have a question come in earlier, and we may have some time to show this, but the PowerOptions tools, of course, if you are self-directed, the PowerOptions tools does have a search screen which includes a lot of these criteria to look for. You can look for the percent probability between, for example, the range in or out of the money, the minimum return that you're looking for, the maximum risk, and of course the tools will also allow you to do a screen just for positions on indexes, ETFs, and holders, or you could narrow it down to just a few indexes that you're using to find and identify the positions that best match your personal risk-reward tolerance.
Right.
Okay, Roma, real quick. Yeah, we'll put the screen up there. I'll let you talk about that in a second. But Roma just wanted to know why is it important for the special margin calculation that the put spread and the call spread be the same?
Well, I actually don't have an answer to that other than the brokers have said that's the way it is. Technically, they wouldn't have to do that. They should be able to take the greater of, but they don't do that. They make it be the same. And I think it's probably just it makes it easier for them. You know, that they see that the margins are equal or not. They don't have to really see, you know, pick the greatest value for the margin. I don't really have a good answer other than that. It's just that's what the brokers have decided.
Mm-hmm. Okay, so why don't you tell us about the different services that you offer there at PowerOptions Applied?
All right. Well, we have two trade folios which trade the Iron Condors, which is what we were discussing today. One is the Optium,
mm-hmm.
and that one is we enter the Iron Condor position usually right after the previous month's expiration, and we stay in it until it expires. You know, at expiration. Usually these are trades that are out 1 month. So when we say, you know, we're going to make this trade folio, we typically try to get returns in the 6 to 8% return, and that's range, and that's per month. So, and you know, last year we had 100% success on every trade, so we made 6% or more every month.
Mm-hmm.
And will we do that this year? I kind of doubt it, and we'll talk about that. Why the reason for that, you know, in the next webinar. But even in, you know, markets like we should see next year, this strategy, you know, should do well. And that's a $99.95 a month, and then we have a really big discount if you want to sign up for a year.
Mm-hmm.
The Chromium is also Iron Condors, but this one we take a little bit different tact. We pick an Iron Condor that has a wider wing, but also a less return, but then in the middle of the month we roll it, and that trade folio is $89.95 a month. And then we also,
right.
All of these we have a yearly discount. All of them have a big discount, and that's what we want. We want customers that they want to be with us for the long term. You know, so that's why we offer the big discount. We have Quantum, which is double diagonal. We'll talk a little more about that strategy in the next webinar. It's very similar to an Iron Condor. It's also a neutral strategy. It has some nice advantages, but also some disadvantages come to when it's compared to the Iron Condor, which we'll talk about next time.
Mm-hmm.
We have Titanium, which is a covered call strategy, and then we have Palladium. You know, the Titanium is covered calls on stocks, and we have Palladium, which is covered calls on ETFs, and then we also do callers on ETFs. That strategy is very nice because it can work in bullish or bearish markets, because if the market turns bearish, we can do covered calls on the inverse ETFs. And then we also have what we call Plus, which is basically everything above
mm-hmm.
Optium, Chromium, Quantum, Titanium, Palladium. And we have a very significant discount on that. You can get Plus for about the same price as you can sign up for 2 of the other ones. So if you, for example, if you wanted to sign up for Chromium and Optium, you could actually get Plus and have everything. So we offer a free trial on all of these products, so we will debit your credit card when you sign up for the free trial. But if within 30 days, you know, you call us or send us an email, we'll refund your money, no problem. We pick, we manage, we trade the positions. We have a website that has all the positions posted. We send out emails with position updates, and you can see the website is PowerOptionsApplied.com. We also are selling the book for $19.95 and then $3.95 shipping and handling. And we have a special offer, and this is just for new subscribers. But if you buy the book, you can get the book and a half price newsletter. We're offering Optium newsletter, and that's for $69.04, and then $3.95 to ship the book. So you can sign up for that at the PowerOptionsSupply.com/condorpromo.asp.
And you can also access the book, of course, just by itself at PowerOptions Apply. That's PowerOptionsApply.com, or at PowerOptions, of course. That's www.poweropt.com. Yep.
We have any other questions, Mike?
Yeah, I'm going through some of them. I keep getting let me just scroll down here and start from the bottom and see where we are. And wow, I have a lot more coming in than I thought I did. I was trying to keep up with them. I think Greg is too. Let's see here. Okay, there's that one. Hold on one second, guys. David, let's see here. David wanted to know, can you show how you have placed and managed an Iron Condor from your listed trades? He would like an example, I guess, of the Iron Condor positions.
Well, the trade that we mentioned today is an actual example of a trade that we placed in July. It was one that was successful, and that trade made 3.1%. It was so that actually was a chromium trade which we rolled, but the initial, if you'd have stayed in the initial position, you made 3.1%. But then that particular trade, after we were in a couple of weeks, we rolled it, and I don't remember the exact return, but we added another like 2%. So we ended up with like 4.5 or 5%, somewhere in that range.
Yeah, I think I got some questions that came in while you were reviewing that last slide that basically got answered. We had a couple. Barry, for example, asked, you have a service that combines Optium and Chromium just using Iron Condors, possibly at a discount. Well, that's what that Plus service was. That Plus service gives you access to both of the Iron Condor services in addition to the trades listed for the other services, and that's at a discounted rate. We had a question about how many Iron Condors do you, how many Iron Condors do you make a month in Optium? And that's usually between 2 and 4. Is that correct, Mike?
That's right. Yeah, in usually 4 positions. Occasionally, we won't find a trade that we like, and we'll only maybe have a couple. But typically, on average, we have about 4. Now, we typically will trade the NASDAQ, the NDX, the S&P 500, SPX, the OEX, the S&P 100. I'm sorry. And then we also will trade the Russell 2000, which is the RUT. That's the 4 broad-based indexes that we trade, and then because we trade those and only those, we are eligible for the tax advantages.
Okay, got a question here from John. Auto trade. Do auto trades include stops and rolling recommendations as well as the original selling of the Iron Condor?
Yes, when we do auto trade, we do all the management. There's nothing else required. We place the trade just like we publish in the newsletter. We post the contingent orders just like we do in the newsletter, and then when if there's a stop loss or we exit or roll, it's all taken care of by the broker.
Okay. Who do you think are, this is an easy question, who do you think are good brokers to use for Iron Condors?
Well, we tend to focus on Options Express because they support, and I was going to talk about this next time, but we'll go ahead and talk about it. They support contingent orders, and a lot of brokers, or at least my experience has been, a lot of them don't support the contingent order. And the contingent order is very important for the Iron Condor because if you cross a certain threshold point, you want to get out. And if you're out, at work or in the yard, you don't want to have to sit there and watch it all the time. You want it to get you out of the position, and so that's what the contingent order does. So that's why we focus on Options Express. But you can trade these with other brokers as well. But if you do, you want to make sure that they support the contingent orders.
Okay. Now I've got a couple questions coming in here. They're related but a little bit different. Let's see here. Where was that first question? Hold on. Apologize for this. FK wanted to know what do you feel is the best VIX number is ideal for trading an Iron Condor? And we had a similar question that came in, not in that sense, but in selling an Iron Condor, when you're looking to get into position, do you start with looking at the VIX or the RVX? As it's not easy to sell a Condor when there's low volatility. You can get into trouble if there's a sudden spike. So what are your sentiments on that when you trade the Condors, Mike?
Well, they're taking all of my material from next time. Well, we'll go ahead and cover that. We did some historical studies on Iron Condors versus the VIX, and what we found is that when the VIX is very high, like above 20, the Iron Condors do very well, at least for indexes, and that's the reason that we did so well last year, was because the VIX was above 20 almost the whole year. And then the other thing we found is that when it gets below 20, it's successful but not as successful. Right? You won't have a 100% success rate like we had last year. And then when it gets below 15, the Iron Condor struggles. has a lot of difficulties with the Iron Condor when it's below 15. And so, above 20, it's smooth selling. Between 15 and 20, maybe a little choppy, but not too bad. It's manageable. But below 15, probably wise to look at something else. And that's kind of what the quantium is, the double diagonal. That's why we introduced that strategy, is for low volatile markets, because we think that strategy will work in a low volatile market like when the VIX is below 15.
Okay. Now, what brokers do you use for auto trade with the Optium, Chromium, or the other trade folios that you use at PowerOptions Applied?
Right now, we only use Options Express because of the contingent order.
Okay. And we did have a question that came in that asked, when the auto trade, you pick the trades, you pick the contingent orders and the management, but we don't actually trade for you. Okay, the auto trade is set up through your broker, but we don't actually trade for you. Auto trading is not really us trading for you. It's you deciding how much money you want to allocate of your portfolio into the auto trade, and then make the adjustments from there.
Yeah, we don't touch your money or even know how much is in your account or anything. We just publish the trades. And if I knew how much money was out there, I might be a little scared.
Okay, we did have a request. Can you go back to the previous slide so we can show the special link there for the book plus the half price? And Mike, people who have already purchased the book that didn't see this particular advantage, that aren't current customers, can they still get the half month there? I'm sorry, the half month of that portfolio?
I think we can arrange something.
Okay, yeah, so I think I got an email from Paul, and I got another question from Dave regarding that. If you bought the book...
I think I heard Greg hit the floor.
Yes, but if you're if you're new to PowerOptions Applied, you don't have an existing account, and you bought the book, and you still want to take advantage of that half price promo there, send us an email to support at PowerOptionsApplied.com, and Mike and Greg will look into that for you. Now, here's an interesting question, and I know your kind of answer to this one potentially because I've seen your trades. FK wanted to know, kind of for RUT, IWM, or the Russell 200, can you compare which one you might recommend for an Iron Condor? And I think you'd probably stay with RUT because you prefer the main indexes as opposed to the ETFs.
Right, yeah. If you want to take advantage of, tax advantages, then the RUT, the Russell 2000, is the way to go, the index. But some people, are trading this in, IRA accounts, and so then in that case, you certainly can trade with the IWM, some of the ETFs, but the issue there is that you're going to pay some more brokerage fees, but because it's going to require more contracts to enter an apples to apples trade. And that's, we cover that in the book, and we actually take an example of I don't remember exactly what was it? I think it was index. We took the index, that's hard to say, and we took the QQQQ ETF, and we put the same trade on for the same day, same wings, same return, everything was apples to apples, but the brokerage fees would have been more because it took almost twice as many contracts. So, but you can do that, yes.
Okay, two quick questions here. Do you suggest cash settled or physical delivery, American or European style options? That's from Dave.
Well, as far as the European American, it's not such an issue because, European would be, the best, but we never let the Iron Condors get in the money. So we never are or even close to getting in the money. So we're not really at risk of having them exercised or anything. So, and that was two questions. I don't remember the other one.
Oh, I'm terribly sorry. I was just looking at the Russell, the IWM, and the Russell 2000 there comparatively. Now, I just had two questions come in a row. I was waiting to address John's question because I thought it was a great one, and then it was followed up by another question from Bernard. Bernard's a little bit different, but John's question is, do you envision that the tax benefit of trading indexes will change with changes in the capital gains and dividend tax laws? And Bernard wanted to know, are you aware whether the tax advantages referred to for index options also apply in Canada? So two different questions there. One's about the capital gains, the adjustments in the law there.
I don't know about Canada. And the other question, I have seen some rumors that this tax advantage may go away. I know some of the market makers are a little upset. I read about some of the proposed tax changes because they also take advantage of this tax, this special tax, this Section 1256 of the IRS. So it could go away. So hopefully not. It's nice to take advantage of, especially if you're trading on a taxable account. You can significantly reduce your taxes. So.
Oh, Mike, can you scroll up? Someone had asked this before. Can you show me the slide there where that tax advantage link was, or where they can get to that tax advantage link? It was on Power Options Applied. Is that correct?
There it is, right there.
Okay. Yeah, it's www.poweroptionsapplied.com/tax-advantage.asp. And if you're on Power Options Applied, I believe you can access that through the is it through the sitemap or through the?
It's on the front page.
It's right on the front page there, PowerOptionsApplied.com. Mm-hmm.
Yeah, it's kind of in the lower right corner. You'll see it says tax advantage. Yeah, that's also known as the 60-40 rule because I actually don't remember which way it is, but 60% of long-term capital, and it may be 40, it may be the other way around, and then 40% of short-term. So basically, with the Iron Condors, the way we trade them, everything is short-term. But with the 60-40 rule, basically, you can take a 60 or I don't remember 60 or 40% of your trade, and you can say, oh, it's a long-term gain.
All right. Okay. Well, ladies and gentlemen, we've gone a couple minutes over. We appreciate you staying with us. We're going to wrap things up. If you have a question that we didn't get to, please feel free to email us. Let's go back to that last slide, Mike, there, so we can show the phone number there and the email address. There we go. So if you have an email question, I'm sorry that we didn't get to, I apologize for that, but we are over time right now. We want to wrap things up. Please send us an email to support@powerop.com. You can call us toll-free during market hours. If you live in the continental U.S., it's 877-992-7971. And, or if you live international, you can reach us at 302-992-7971. I want to remind everyone, of course, that we are having the follow-up presentation. We'll send you all an email regarding that. That will be on April 9th, Friday, April 9th at 12 noon Eastern Time. And shortly, sometime after that presentation, maybe a week after that presentation, where we go part 2 of the Iron Condor discussion, we'll have a third presentation that's just going to be using the Power Options tools for self-directed investors on how to use the tools to identify the Iron Condor positions and using the tools to track the positions and possible management as well. So we hope to see you all there for that. Mike, a lot of people are writing in. We've got Nick saying thank you. Great presentation, Mike, and Q&A. Look forward to the next presentation.
You're welcome.
And Dwayne as well, Ben and Mary all say the same thing, echo the same sentiments.
Yeah, we'll have some really good stuff in the next webinar. It'll be some really interesting stuff.
And this presentation, excuse me, we got a bye and thank you from Brussels. So Victor, thank you for that. This is recorded. This is going to be archived. So excuse me, so we'll have this available next week in the archives on Power Options and on Power Options Applied. So you'll be able to reference that again before the new presentation on April 9th.
Right, very good.